And good morning once again, options traders, and welcome back, everyone. And I wanted to create a video on a specific strategy. Let's just pick, let's say, the short iron butterfly and raise the question, why would you use this? And I like to do videos like this because too many times traders hear about these seemingly bizarre sounding strategies, such as a short iron butterfly, and they'll say, why even bother? A butterfly is a butterfly. Yeah, there's different ways to construct it, but I only need to know one way. That is simply not true. These strategies were all created for a reason. They're all tools. And we might want to use one version, let's say, because it makes a particular morph easier, or we might want to use another version because of skew curves. And so really to succeed with options, you should understand all of the strategies and why they're used. So why would somebody use a short iron butterfly? Well, before we talk about this strategy, let's talk about the skew curves, because this is really what it comes down to. And I've talked about this in a previous video talking about trading in the trough. And so, for instance, what we're looking at is a particular expiration, let's say October, and these are various strikes. So we're going to take a look at what's called a vertical skew, or typically just called a skew curve. So if the stock is trading at 20% volatility, theoretically, the 35 strikes should also be trading at 20%. So should the 40, 45, and so on, theoretically. And according to a pricing models always assume that all strikes have the same volatility. Well, in the real world, that's not true. We're not going to get this flat curve. Instead, we're probably going to see things more like this. We might see the implied volatility of this 35 strike sitting way up here. It might be priced at 30 or 40 or 50%. The 40 strike will probably be priced a little bit lower, and then the 45 a little lower. The at-the-money strike will normally be exactly equal to the stock. And then as we start going out this way to the higher strikes, we will start seeing the higher implied volatilities again. So this is a typical skew curve. Part of the reason that this occurs is that traders like the insurance value of the puts, let's say for the lower strikes, and they're willing to pay for a little bit of a premium for these out-of-the-money strikes. Conversely, traders like out-of-the-money calls for speculation, and they're willing to pay these small premiums for the right to control shares for a very, very small amount. And so that's what can cause this kind of a U-shaped, sometimes called a volatility smile. So when you get these types of curves, and again, this is most common, your strategies for spreads should center on buying the cheap volatility, not necessarily the cheapest option in terms of dollars. So we might, let's say, buy the 50 and sell the 55, or maybe buy the 50 and sell the 60 if we're looking at maybe vertical spreads. Or we could go the other direction, buy the 50 and sell the 40. Of course, this would depend on whether we're bullish or bearish, but we should at least put the volatilities on our side as well. So as I said, this is a normal skew curve, but what can happen, let's say, during earnings season? Well, let's say that we have a stock trading for 100, but traders believe it will either be 90 or 110. Okay, so traders have this preconceived idea that the earnings are going to be explosive in one direction or another. If they're really good, the stock could be up at, let's say, 110. Or if they miss or aren't as good as expected, maybe it will fall to 90. Well, that's part of our outlook, but what else should we expect? And I've talked about this in previous videos about the Volatility Crush. And this just simply means that all of that implied volatility is going to come out on the earnings announcement, right? Everybody's willing to pay a lot prior to the earnings when there's unknowns. But once the earnings are announced, they're all known. So nobody's willing to pay those high volatility numbers anymore. So let's say, should we buy a $90 put trading for 5? Well, if you buy that and the stock falls to 90 and all of the volatility comes out and we're close to expiration, congratulations, you paid 5 for a put that's pretty much worthless, even though the stock fell 10 points. Should we buy the $110 call, let's say trading for about 5? Same thing in the other direction. If the stock does rise to 110, but we're out of time, we're at least very close to expiration, and all of the volatility comes out, that $5 option is going to get chopped. May not be 0, but it's certainly not going to be more than 5. So buying the 90 put or buying the 110 call by themselves doesn't seem like such a hot idea. In fact, if anything, we'd like to maybe sell them. But what about the 100 straddle? The 100 straddle is something that we would like to buy because we know that it's going to move. We know that that stock price, or at least we are expecting a big movement from that current price. And so if everybody says, I really like the idea of buying this 100 straddle, so what's going to happen as everybody figures this out? Well, traders rush out to buy the 100 straddle. And as they do that, they pump up the implied volatility to these very lofty levels. And as astute traders, we might say, you know what, statistically, it's better being off on the opposite side. The implied volatility is too high. And so what can happen is that traders rush out to buy this 100 straddle. And as they do, again, they're pumping up that price to very lofty levels. Some other traders might say, you know what, we'd actually like to sell some of these out-of-the-money strikes. And whether we do them as part of spreads or as a naked position is entirely up to the traders. But my point is, people are buying that center strike, let's say that 100 straddle, and possibly selling the out-of-the-monies. And those actions will invert that implied volatility curve. And so a lot of times during earnings, this is what we get, an inverted IV curve. And so it's going to look something like this, more like a frown instead of a smile that we saw before. So notice that the highest implied volatility is for at the money, and then it starts to fall off as we move out away from that center. So what could we do in these cases if we think that the straddles are overpriced? Well, this is where the short iron butterfly can come into play. To put on the strategy, you will buy the 95 put, for instance, sell the 100 put, sell the 100 call, and then buy the 105 call. So notice that if you're familiar with a traditional butterfly, we buy the wings, the 95 and the 105, and we sell the center strikes. But normally, the position is built with either all calls or all puts. With the iron version, we're using both. So what does that do for us? Take a look at the centers. If we sell the 100 put and sell the 100 call, isn't that the 100 straddle? And that's kind of what we'd like to do, is to sell that. But we don't want to sell that by itself, what's called a naked straddle, because we've got unlimited risk. So we buy the wings out here as a hedge. And because these are probably theoretically cheap. Everybody wants to sell these, everybody wants to buy the at the monies. So again, our perspective, we'd like to perhaps be selling the straddle and hedging with the wings. And we're doing that because the implied volatility for these at the money options is just through the roof. So that's our focus, is that we'd really like to sell the straddle, but we don't want to sell it as a naked straddle. So if we put on the short iron butterfly, it's going to look just like a regular butterfly. See, I could buy a call butterfly and get this risk graph. I could buy a put butterfly and get this risk graph. But I could sell the iron butterfly and get the same one. So it will be a credit. That's the most you can make. The most you could lose down here is the difference in strikes minus your credit. But the main thing I'm trying to show is that if you look at this upside down V right here, that is your short straddle. That's really what we'd like to sell, but we've got unlimited downside risk and unlimited upside. We don't want that. We want to buy these protective wings. And so when we put these pieces on together for the right reasons, this is what we get. And of course, today our graph is going to look like this. And as we get towards expiration, really on the earnings announcement, this red curve is going to jump pretty close to that blue. And so it's really more of a binary event. We're putting this on before the earnings and waiting for it to just completely collapse on the expiration graph in a very short time. So that's the short iron butterfly. Now, there's a lot of other reasons why we might use it. It's a great one for morphing in either direction. But I just wanted to point that out mostly for our new traders who are under the false belief that a lot of these strategies are completely useless and they're just way too detailed and you don't need to understand them. It's simply not true. They are really powerful tools if you know when to use them. So for anyone who'd like to learn more about the art and science of options trading, please check out the Alpha Trader course, Strategy Lab, and a brand new technical analysis course, all at optionsatoz.com. Also, please join us on the Facebook trading group options A to Z, and you can find a link in the description below.